The mainstream is going to toe the company line until it is so obvious that it's a lie, they can no longer do it. Welcome to this edition of Crashes and Taxes. This is the last Crashes and Taxes for 2023, and it is our 100th episode. I am so excited to be joining you today for Crashes and Taxes. It's the end of the year. Hope everyone had a wonderful, wonderful Christmas. And we are going to basically have a high-level overview recap on this podcast. We're going to go through kind of where we are globally and what the world is doing about it and what the United States is doing about it. And then we'll go through some microeconomics as to where we are right now and why I don't believe what the market is trying to sell us. And we'll talk about like what can you do about it, what to expect for 2024. What I can tell you about 2024 with absolute certainty, without any doubt at all, in my professional opinion, is that this is going to be the year of global reckoning. There is going to be a shift in 2024. It is coming. It will happen. I would bet every last, I bet 90% of everything I have on it. I would always keep 10% back just because I'm a literal person and there's never a 100% guarantee of anything. But based on the information I'm about to share with you today, the recap, and the information that I share might not seem to you to be revelational, but I'm telling you that it is enough to bring about what is going to happen in 2024. In other words, we are at a precipice. And everyone, and there's a lot of experts that do this, and so I'm not knocking the experts, but anybody that shows you, and I'm going to show you today in this presentation, this Crashes and Taxes, anybody that shows you that the total global US dollar denominated foreign exchange reserves is still, in excess of 60% of the world, which it's not, it's just under 60% now. And therefore, it will somehow magically continue to be stable and be what is the reality forever. That is just a false hope. That is a false hope. And we don't manage our global wealth. We don't manage our finances. We don't manage our cash flow on false hopes. So my goal today is to really try at a high level with some details and granularity to really get you to understand that we are here. It is upon us. And 2024, I expect this time next year that this podcast won't even be necessary because everyone will have experienced the global economic and currency transition that we will go through in 2024. And that's where we are. So let's go ahead and let's get started on this 100th episode of Crashes and Taxes. And by the way, we just had winter solstice and Christmas. So I hope that all of you had a wonderful celebration with your family, and happy holidays to everybody. I want to start off with this quote from Plato. For those of you that are part of my practice, you know that I harp on this as clients. I harp on this. I reiterate it over and over and over, and I will reiterate it here with you. It's a quote from Plato: "Those who are able to see beyond the shadows and lies of their culture will never be understood, let alone believed by the masses." We have a situation that during the Obama administration, the media and the repeal of SWIFT allowed the media to propagandize the American public. In other words, they were authorized for the very first time to directly lie to the American public. It is now legal for that to happen. It was previously not legal. Well, this has emboldened what was already happening on Main Street and Wall Street with media, sort of giving us their viewpoints, their ways. Remember that media, 90+%. I want to say 93, but I won't give you the number if I don't know exactly and I don't have a source for it. But there's in excess of 90% of our media is really controlled by just 6 corporations. And so the consolidation, the mergers and acquisitions in this space has really given us such few actual sources. You really have to seek out independent news sources. I like the Epoch Times. That's a good one. EPOCH. Epoch News. There are so many others. I'm on really deep global channels that I won't even go into here because I always try to bring mainstream American news to the mainstream American audience that Crashes and Taxes speaks to. But for those of you that are really interested in this particular podcast and what's going on globally, you're gonna have to move beyond the mainstream. The mainstream is going to toe the company line until it is so obvious that it's a lie, they can no longer do it. In other words, they are going to keep you believing what they want you to believe until they can no longer convince you of their lies. As long as they can say it loud enough, and say it enough times, they have the American public believing what they want them to believe. They've really had us believing what they've wanted and the picture they've been presenting. I would really say in earnest since 2020, probably 2008 even. Too Big to Fail comes to mind. But I'm just going to tell you that we are being propagandized every single time we put on that media, because so much of that message is literally decided at super high levels, and then it's disseminated down to the corporations that carry out messaging. And this goes back to Project Mockingbird in the 70s. The CIA infiltrated both Hollywood and news media. This is a documented, publicly released fact that you can go out and verify for yourself, that the government has infiltrated both the movies and the media, news media, so that they can get out their message. Now, that was not that outrageous or anything. I mean, governments have a right to communicate with their people in different mediums. But once through the Obama administration, things became legal to lie and to blatantly present false and disinformation, that's when we start to really have problems. So for those rare people that are on this Crashes and Taxes, that are seeing beyond the lies, the obfuscation of what is really happening in the world, you are not going to be believed by people. You're not going to be understood by people. People are going to say you're nuts. What's wrong with you? And I will just say, as a general rule, because the general consensus at the end of 2023 here is that everything is fine, that a soft landing is in the process as we speak of being realized, that the Goldilocks scenario of it's not too hot, it's not too cold, it's just right, that scenario is being believed, is being delivered, or in the process of being realized as we speak. And I am telling you, it is the falsest thing that has happened to the American public, because we are not fine. Things are not okay. And we are at a precipice moment. And we will not get through 2024 without the reckoning, without a reckoning. It's the starkest warning I can give you. It is coming. We are out of time. So let's go into it. First thing that we want to cover is this BNN Bloomberg article that just basically came out recently. You can see here that it says that the Bank of America poll shows that rate cut expectations are fueling a rush back into the market, back into equity. So we are seeing a rotation from cash back into the market, and it's a very clear, you can see the uptrend easily leading to December of 2023. Investors are the most optimistic since beginning of 2022 as expectations of policy easing by the Federal Reserve are fueling a rush into stocks, according to Bank of America corporate survey. The sentiment of global fund managers surveyed in December was the most upbeat since January 2022 on a goldilocks environment, a steady economy that is not running too hot or too cold, as the case for next year, 2024. A team of strategists led by Michael Hartnett wrote in Tuesday note. Against the backdrop, the poll showed investors are the most overweight on stocks since before the Fed started to hike interest rates in March of 2020, with cash allocations cut to a two-year low of 4.5% from 4.7%. Meanwhile, fund managers are the most overweight on bonds in 15 years. They are also the most bearish on commodities relative to bonds since March of 2009. Policy, not positioning, is the new tactical driver of asset prices, Hartnett said. I want you to hear that. Policy, not positioning, is the new tactical driver of asset prices. What is Hartnett saying? He's saying that monetary policy of the Federal Reserve and central banks, the Bank of International Settlements at the highest level, the highest echelon, the central bank of all central bankers of the global earth, and the Federal Reserve here in America, it's monetary policy and central bank policy that is not positioning, but policy is the new tactical driver of asset prices. So they're saying that it's not reality that drives the prices, it's Fed or central bank policy. That is a pronouncement. That is an admission that we have gotten to a point of monetary policy and being controlled by a central bank, that our stock market is dictated by central bank policy, not by what is actually going on in the market. Wow. The Fed's last meeting of 2023 fueled expectations of a dovish tilt with the likelihood of interest rate cuts next year. The S&P is approaching a record high, while the NASDAQ 100 has already breached the record level this year. Even with the rally, Goldman Sachs Group said U.S. equity funds received flows of only $5 billion through 2023, while money markets got a record over $1 trillion. Investors are expected to use their cash to fund equity allocations in 2024 as interest rates come down and inflation eases. A net 91% of the Bank of America poll participants said hikes from the U.S. Central Bank are over, and expectations of lower rates along with bond yields are at a record high for this century. Bonds and technology are seen as the biggest winners from the Fed cuts. In terms of risk, investors are most wary of a hard landing or a recession in 2024. That said, a net 66% is anticipating a soft landing for the global economy over the next 12 months. Now, here's where you can win, because you're not going to be the mass. You're not going to be the 66% of delusional people that believe the propaganda that comes out of the media regarding the economy, the Federal Reserve, rate cuts, and what the market is going to do. We can be an outlier just by being a contrarian against the masses. And anytime there's general mass consensus that something's going to happen, you know that there's some kind of problem, because that never happens, that everyone believes something's going to happen and then it actually happens. It's just not how the market works. Hartnett said the best hard landing contrarian trade is going long on cash and shorting the group of stocks called the Magnificent Seven, such as Apple. The poll was conducted between December 8th and December 14th. So this is where the world is at, and certainly in the United States. We think everything is going to be fine. We think the Fed is going to soften. They're going to be dovish. The market has priced in 6 rate cuts, even though the Fed has only announced 3. So let's see what everyone believes is coming for 2024. And so you can see here, this is a consolidation of multiple different data sources. So this is the Fed Bank of New York. This is a Conference Board of Governors. This is a Bank of America survey, and this is also a Goldman Sachs investment investment survey. So we have 3 different sources of information here, but all of these sources ask the same thing. What is the likelihood or probability that a recession is coming in the next 12 months? This was asked at the end of this year here. You can see that the Federal Reserve, Wall Street, basically right here, Federal Reserve staff and Wall Street is saying 0. There is a 0% chance of recession. So that is impossible statistically. There is never a 0% chance of anything statistically unless there is a null set and there's not an option. So they are at 0, which automatically should send alarm bells through you. They're not even acknowledging the possibility of a recession after everything that's happened. And the one thing I want to make absolutely clear is that we are in completely uncharted territory. We are in completely uncharted waters. We have never printed this kind of money before. We had a monetary change. We're going to get to it. We're going to talk about this. We had a massive sea change of policy in 2008, but we took that change in policy to the next level, to the ultimate highest level possible in 2020. With the coronavirus pandemic, and none of us and no one in the history of time has ever lived through the results of the repercussions of an action that is that big and that aggressive. So anybody telling you absolutely for certain this is what's going to happen cannot possibly know, because we have never tested these waters before. We've never sailed these waters before. We've never gone through storms like this before. We've never been this globally connected before. It is all novel. It's new. And therefore, no one should be as arrogant as saying there is a 0% chance that we have recession after everything that we have gone through since 2020 and since 2008. So the Fed is extremely arrogant to be at a 0. Wall Street is extremely arrogant to be at a 0. Let's look at fundamentals. The next thing we want to look at is, what does the yield curve tell us? The yield curve has been inverted for extensive amount of time, over 12 months. We see in yield curve inversion. And so that gives us a 61% statistical probability that we will have recession in 12 months. That is the math of yield curve inversion, 61%. So that's a problem. Then you have economists. Economists have surveyed, and the economists, 48% say we are going to see recession. How can you have economists almost half saying recession's coming, and the Federal Reserve, which is filled with PhDs and economists, is saying 0? Nobody on the Fed believes we're going to have a chance of a recession. These are the things that give people like me pause when you have a Fed that's not even really willing to admit reality. So we have economists and we have the yield curve showing us we have almost a 50% probability of recession. We have the Fed at 0, complete disconnect. And then let's look at consumers. Main Street, 69% of consumers believe that we will have recession next year in 12 months. So basically, people that are living in this economy, paying higher food costs for their bread, their eggs, their cheese, their meat. Maybe they're not buying meat. Maybe they have to work 2 jobs now just to keep up with what they previously did with 1 job. Nothing is keeping up. We are seeing this. We are seeing highest delinquency on credit cards coming up. We're seeing highest balances on credit cards. We're seeing high delinquency on high interest rate car notes. So we're starting to see the repercussions of why 69% of consumers are saying, yes, definitely recession. Then let's look at some C-suite. We've got Goldman Sachs putting out at 15%. I don't agree that it's only a 15% probability, but at least they're not saying 0. So that's good. Bank of America, they're saying 35 to 40%. And then you have the highest group at 84%, and that is our CEOs. Our CEOs that see all, that know all, that deal with global trade, that deal with cost of capital, that deal with refinancing massive, massive levels of debt, that deal with dividends and reinvestments and stock buybacks and cost of goods sold across the world and shipping problems and geopolitical risk of the Red Sea shutting down and geopolitical risk of the Black Sea and what's going on between Russia and Ukraine, on and on and on. And what do these CEOs that have all of this data globally say? 84% of our C-suite CEOs say recession is coming in the next 12 months. But you guys, I want you to step out of just this micro focus on the next 3 months, 1 quarter, 2 quarters, 3 quarters, 4 quarters, 1 year. And I want you to understand that we are not down here at this level just talking about micro policy changes and what's going to be impacted in the next 12 months. We are up here with global systemic translational transformations of the global economy. I advertise for the business, that change and unfortunately massive change is unavoidable at this point. And I always get the yahoos that, wackadoos, I call them, that will reply as a comment and say, what are you talking about? The stock market is up. This is happening. This is fine. This is fine. The Fed is going to cut rates and the stock market is up and everything is fine. And it is so the propaganda bullet points 1, 2, 3, 4, 5. You can watch any Main Street news program on any given day, and you can see these 10 bullet points being repeated over and over and over. And you can say, okay, you bought into the Kool-Aid, and good for you. But for the people that don't want to buy into the Kool-Aid and want to actually understand the reality, what's really happening, we just aren't going to play that game. We're going to call a spade a spade. We're going to go through the fundamentals of what has changed and why it's over. And then you can believe what you want from there, but at least understand that we are not talking about what's happening on just a short-term window basis. Because when you go through these kinds of evolutions really of finance globally, you don't care about what happens in the 6 to 8 months before or after, because the biggest most important thing is to bridge the assets and the wealth that you've created and you've built and you stored, bridge it from the current system to the new system. You have to bridge it over, because while everyone else is in the existing system and thinking, oh my gosh, look, everything's fine, the central bank's going to cut and we're going to have lower rates and everything's going to be great, while everyone's hyper focused on this super short term, right? They're going to be sucked into the fear of missing out of the Wall Street is having a great 2023. Let's get in, let's stay in, let's ride this wave. And you know what? Oh my gosh, so many people are going to be caught and trapped in that lie. They're going to be sucked up into its vortex and they're not going to escape. And that means their wealth isn't going to escape. And this is exactly what they want. They want you having your money held in financial derivatives. A financial derivative is an asset value that has no intrinsic true hard value because it is derived from something else underlying it. For example, a stock certificate is that I own a somewhat percentage share of this corporation. So your stock doesn't have any true intrinsic inherent value in and of itself. No, it is completely derived from the value of the corporation. So if the corporation is doing great, then your stock price is going up. If the corporation is not doing great, your stock price is not going up. That's a financial derivative. How about a bond? A bond is a financial derivative because it has no true inherent value. Its contract value, yes, but its contract value is derived from the corporation, the company, the bank, the central bank, the treasury that created that bond, that treasury, and gave it value. And so in the United States, the US dollar is backed by the full faith and credit of the United States government, the United States Treasury Department. However, it is fiat capital. It is based on nothing except for the solvency of the US Treasury, which we're going to talk about today. So the C-suite at 84% means they know something and they are expressing it. It might not make the mainstream news and the 5 bullet points, but that's because they have a very specific need to keep you in your financial derivatives so that your wealth can be collapsed. This is a designed and planned thing. There is no getting around that. Henry Kissinger passed away this year at age 100. He died in 2023. He was instrumental in deriving the petrodollar. He is the person, as Secretary of State under Richard Nixon in 1971, that negotiated on behalf of the United States a deal with the King of Saudi Arabia to 1974, we came off the gold standard in 71, to create the petrodollar, to basically become the United States becoming the security for Saudi Arabia in return for Saudi Arabia, which controlled the OPEC bloc, not including Russia, which is OPEC plus, to sell crude exclusively since 1974 in US dollar, thereby quasi-backing the US dollar to a hard asset again, crude, and crude oil. And that petrodollar has been the stability of the hegemonic control of the dollar since 1974. Henry Kissinger passing away this year infamously is quoted as writing or stating, who controls the food supply controls the people. Who controls the energy can control the whole continent, controls whole continents. Who controls money can control the world. And this is it. This is the fundamental thing that Henry Kissinger realized. You know, if you can control food, you can control people. If people can't feed their kids and their kids are starving, they will take the most risk they've ever have in their life. I'm a mom, I'm a mama bear. If my kids aren't eating, I can't even imagine what I would do. So you control food, you control people. You can control energy, you can control countries. What can they do? What can they produce? What's their GDP? If you control the money, you control all of it. The money supply and the control of money and the expansion and contraction and the tightening and the loosening of the money supply is the thing that controls the world. And we just read the Bank of America survey, Hartnett saying policy, monetary policy is what is controlling. So we have gotten to a level now that it's not the true fundamentals of the market of economics that's driving the returns of the market and of economics. We have gotten to the point where it's truly based on cash flow stimulus, and it is truly based on the control of the money supply through central banks. A lot of people don't understand that there's really only been 6 different modern controls of global world finance. And so you see Portugal 1450 to 1530, Spain 1530 to 1640. These are the world global reserves. Obviously, you know, we're talking about since way past the Ottoman Empire, past the Roman Empire, where we're talking modern era 1450 and on. Netherlands 1640 1720, France 1720 1815, Great Britain 1815 to 1920, United States 1921 to today. The reason the United States is put in there as 1921 and not 1944, 1944 is where at the end of World War II in Bretton Woods, basically they met to pass and to vote on a global world reserve. And they agreed that the US dollar would be backed and be able to be converted into gold at 35 US dollars per ounce of gold. That was the fixed exchange rate for decades. And so really, how come it goes back to 1921 instead of 1944? And it's really because what happened in World War I was you had the world, you had the industrialization of the United States becoming a military and industrial superpower, really through the Industrial Revolution. And what you had was the world contracting with the United States to create things, to make things, and they were doing that in US dollars, and they were accepting US dollars, they were paying US dollars. And for that reason, you see that the United States dollar is really attributed towards beginning in 1921 instead of 1944 with Bretton Woods. Now, we need to look at this entire situation with the United States. Again, we're not looking at the micro short term of 6 to 18 months. We are looking at 150 years. So basically, we're looking here at 1900, and our first data point is in basically 1917, and that is literally the World War I scenario, where you can start to see that the United States started to go up and become somewhat of a player. And we obviously did get some debt in World War I and came back down. And then you can see that we had for only ever before one time, and this was at the height of World War II, 1940, I think it says 3, it's hard to see, it's a little bit grayed out, but you can see that for the first time ever in the history of our country in World War II, we did debt finance, we did have debt equal to 103.9% of our gross national product, our GDP, gross domestic product. And you can see that we subsequently paid that down, dropped that down, and we're really low. And really right before the 2008 too big to fail scenario, you can see it right here, we were at 35.2%. 35.2%. You go back to the 80s with Volcker. Paul Volcker was the Fed chair from 1979 to 1987. He dealt with the S&L crisis in the 80s. He dealt with mass inflation, and he handled that by being very hawkish and raising rates to 20%. But Volcker was able to do that because at that time, our debt to GDP was only in the 30s. In other words, the United States, the Federal Reserve could afford to pay 20% interest rates because we didn't have a massive amount of debt. We weren't a debt-ridden nation. So you fast forward that to present day of 2008, before things changed, you can see that we were still low at 35.2%. And then you get to the beginning of 2020, and you have the global pandemic, coronavirus, and you can see that we immediately jumped to right at 100% debt GDP. And I want you to see that we jumped to about 70% just from 2008, where we were at 35, to 2000 and basically 20, we really increased our debt to GDP. You can see this trend of coming up sharply, and then it all bets are off. And we're going to explain what that was and what happened. So this is the highest quarter of debt to GDP in the history of our country. The top end, Q2 of 2020. This is coronavirus right here. I remember being in DC in March of 2020 at a conference and getting home and getting an email from the conference and saying, which said, this is like March 4th of 2020, somebody at the conference has tested positive for coronavirus. You've probably been exposed. And so that following quarter, that was March, that's the end of Q1 for 2020, and Q2, our debt to GDP, because of the stimulus that we printed immediately, jumped up to our highest level, almost 133% debt to GDP. Now, our most recent report that we have, this was updated, you can see up here in December 4th of 2023, you can see Q3 of 2023, so just last quarter, what was our debt to GDP? Right at 120%. So you've got a different Fed in Jerome Powell, as he doesn't have the ability to be Volcker-esque in his ability to handle what has happened, as we have too much debt. And so as he decided to go crazy on raising rates, it had a delirious impact on the US. So what happened? What really truly happened in modern times to put us at this massive debt to GDP? And what you're really seeing is a monetary policy shift. The United States shifted its monetary policy in really 2008. I pinpointed at 2008, and specifically this too big to fail mentality when banks were lending money to institutions that were later described as toxic loans, the Troubled Asset Relief Program. Toxic assets were going to be bought by the American taxpayers off of these banks' balance sheets to save our banking system. Now, at the time, a lot of people, including myself, thought this is just ridiculous and way too aggressive, and it doesn't help the banks make better decisions in the long term if they know they're going to get bailed out. In fact, we're going to go over that. And so what was it? What was this federal central bank monetary shift? And it really is what we call modern monetary theory, MMT. I've got this summarizer here for you to just give you just the crux of it. And you don't have to study economics to follow my podcast, but you can see that this is a heterodox macroeconomic theory that suggests there is no financial constraint on government spending as long as a country is a sovereign issuer of currency and does not tie the value of its currency to another currency. In other words, if you are the reserve currency, if you are the global standard of global reserves, if you have a hegemonic status, as long as you're a sovereign issuer of currency and it's not dependent on some other currency, which if you're the world reserve hegemonic status, it wouldn't be, it would be dependent on just you, then you can have zero financial constraint on government spending. MMT describes currency as a public monopoly and unemployment as evidence that a current currency monopolist is overly restricting the supply of the financial assets needed to pay taxes and satisfy savings desires. This is what is highlighted for you. MMT suggests that the government could simply create more money without consequence as it's the issuer of the currency, and government deficits and national debt don't matter nearly as much as we think they do. MMT has become increasingly influential on the left, giving progressive politicians a reason to believe that a high price tag shouldn't stop the US from instituting wide-ranging social reforms like Medicare for all, or i.e. universal health care. So we shifted to modern monetary theory in 2008 because of the Troubled Asset Relief Program, because of too big to fail, because of the Federal Reserve stepping in under the direction of Ben Bernanke and saying, we are going to go dovish, we are going to stimulate the heck, and we're going to buy these assets. Now, as much as that was repulsive to many, many people, buying the bank's toxic assets to save our banking system doesn't seem like the way to go, but we also don't want to have a banking crisis or collapse, so therefore it is the way to go. That was the lesser of two evils. We don't want to collapse. We don't want to embolden these banks to make bad loans. We want to make sure that they're being held accountable, but we can't let them fail. Thus, they're too big to fail, and therefore they must be saved. And the lesser evil is saving them than letting them collapse. And at that time, we thought that was awful, and that was only $800 billion. TARP was $800 billion. It wasn't even $1 trillion. Now we pass $1 trillion program like it is water. Air, unlimited. Let's go back over what happened with Silicon Valley so that you can understand what happened. Silicon Valley had the largest bank run in one day in more than a decade. You can see here, this was printed March 11, 2023, that $42 billion was withdrawn in one day, the largest bank run in a decade. What happened to bring Silicon Valley to this situation? And a shout out here to Patrick Bet-David, who did a really great podcast on exactly this crisis. I would definitely recommend that you look at his podcast. But you can see here that what happened was Silicon Valley Bank was really a $50 billion bank all way until 2020. You can see their assets were just at the $50 billion mark. No problem, no problem. And then in 2020, their assets jumped from 50 billion to reach over 200 billion within 2 years. So that right there should tell you something. We're a IPO bank. We're dealing with the startups and the IPOs. We're funding and we're working with these companies to IPO, or we're doing bank facilities for them while they're IPOing. And we've been a $50 billion bank forever. But now, once coronavirus stimulus is being pushed into the market, we are 4xing our deposit level from 50 billion to over 200 billion. So that should tell you that our stimulus created additional economic activity with institutions, with companies that wouldn't have otherwise happened. And anytime there's government action that creates market reaction, that is stuff that would not have otherwise happened, there's repercussions that will come. There will be repercussions for every government action. There's some kind of equal and opposite market reaction. It might take time for that market reaction to be revealed and realized, but it will not be stopped. It will come. The government cannot control everything by just printing more money. In fact, we'll see that they're actually making it worse. So at the beginning of 2022, you had all these massive deposits being held by SVB to over 200 billion. And what banks typically do is they usually make loans. But SVB is an IPO bank. So they're not really making a lot of loans. They decide we better manage our liabilities of this large, because remember, a deposit is a liability to a bank, right? Because I can go, if I put $100 in, I can go and spend that $100 anytime, and that bank is liable to pay that $100 when I call for it, when I demand it. It's called demand deposit, and that's what that means. So SVB went out and bought $100 billion in 3-year bonds, paying a 1.7% average rate of return, because that's how low our actual Fed funds rate has been since 2008. Lower for longer. We've had 15 years of a 25 basis points. That's 0.25% of a Fed funds basis since 2008. 15 years. And so SVB thought, well, we're doing great. We've got 1.7 on 100 billion. Everything's fine. Until there is a bank run. Until people say, wow, there's a liquidity situation happening here. Something's a problem. So SVB, at $42 billion of deposit withdrawals in one day, you can see that they were forced to sell part of their bonds. They sold 20% of their bond portfolio, 21 billion, at a loss of 1.8 billion to be able to pay these investors their withdrawals. This bank run created such illiquidity that they had to sell their bonds at a loss. Once they sold their bonds at a loss, it was realized, and that's when the FDIC and the basically had to see that the limits were hit and triggered, and they had to step in. And then the bank was taken over, and you know the rest. So the Federal Reserve realized that, wow, we have raised these rates so fast that liquidity crises are now going to come, because really since 2008 and switching to monetary theory, we've had so much stimulus pumped into the economy from the Federal Reserve with a very low cost of capital, that any drying up of the low cost of capital, which makes investors and borrowers not want to borrow when the rate's much higher, or any drying up of the constant stimulus, is going to give our economy of consumption-based, always having more and more and more, and that's where we get our growth from, additional capital, additional capital, additional capital. Once that is no longer happening, liquidity is drying up, that's when people are starting to see there's a problem here. I don't think this bank is safe. I'm going to take my money. So they were forced to sell these bonds at a loss. The Federal Reserve then had to get involved. FDIC got involved, triggered FDIC. And you can see, and we know what happened from there. Here's an article from Barron's in March of this past year, after the whole Signature Bank and SVB Bank happened. And you can see that the FDIC, you can see what it says, the FDIC made need to do some juggling to pay off depositors. So Barron's sort of gave us a heads up. Remember, I have a lot of sources globally, but I always try to bring US mainstream sources to this podcast so that we can have really unassailable data that we're relying on. And it can't be assailed by the left or the right or anybody for that matter. But you can see that Barron's was already kind of indicating in this March article that there is problems with the FDIC and that they aren't as solvent and as readily available to step in and fix banking liquidity crisis problems as they're supposed to, as they exist to. The FDIC has promised to make all depositors whole at failed Silicon Valley Bank and Signature Bank, regardless if they were insured or not. So now we're not even saying that we'll just insure 250,000. 81% of the deposits at SVB were not FDIC insured. Why? Well, we're talking about corporate America. We're talking about startups. We're talking about businesses, and beyond that 250,000, your FDIC insurance is over. So if you've got millions of dollars in an account at a bank, the first 250 might be eligible, depending on who you are, for FDIC insurance, but the rest is not. So 81% of these deposits at SVB were not even FDIC insurable. Yet the FDIC came out and said, we are going to insure everything, whether it was insured or not. Why? Why would they do that? The answer is so simple and transparent. They did it to stop the bank runs that would have come. They did it to reinstitute confidence and calmness, because our banking system, a fractional banking system, a fractional reserve banking system, look it up, fractional reserve banking, Google it, fractional reserve banking. Fractional reserve banking, by definition, is insolvent. It is illiquid. You deposit $100, the bank at a 10% reserve rate keeps $10 in your account, literally, and they loan out the $90. It's called the money multiplier effect. It creates more money supply. $100 is really just in the bank, but $90 is now out, being lent out for whatever other purposes, and it creates additional money supply and liquidity in the system. So the FDIC came out and said everything's insured because they had to stop American public from thinking that there was a problem with our banking system. Because if the American public believes there is a problem with our banking system, there is. It's over. We cannot have people going to their bank to withdraw their money because the money is not there. It's loaned out, it's in bonds, it's in treasuries, it is not in cash at your bank, I can assure you. So they went and they took the extreme measure of saying we're going to insure it all. If all depositors decided to take their money today, the FDIC doesn't appear, this is from Barron's, if all depositors decided to take their money today, the Federal Deposit Insurance Corporation doesn't appear to have enough money in its insurance fund to pay everybody off. But now that the government has promised a backstop, the reality is that all depositors are unlikely to bolt at once. And the two failed banks hold billions of dollars in treasuries and loans that can be sold and used to make many of the depositors whole. On top of that, the FDIC has other resources it can tap to raise more funds as necessary. At the end of the day, any banking system is about confidence. You have a 10% capital and 90% liabilities. It's right here in Barron's, you guys. You have 10% capital and 90% liabilities. You have to have confidence that when people go to get their deposits out, they have confidence that the bank will have enough money to pay them back, said Cornelius Hurley, a banking law professor at Boston University. By the end of 2022, SVB had lost $173 billion, had about $173 billion in total deposits, and $151 billion, or 87%, were uninsured by the FDIC. Signature Bank had 89, of which 79 of 90% of those were not insured. So these are two basically business banks that are mostly not insured at all by FDIC. And even those banks, the FDIC came out and said, we're going to cover it all. Why? Because they could not afford to lose the confidence of the American people, because that is the only thing that keeps our banking system working. People have the confidence that their deposits will be there and they'll be able to use them when they need them and when they're ready. And because of that confidence, they leave the money in there and it can stay in the system. The second people lose confidence, they go take their money out. That creates a bank run. The bank run then inevitably creates the very collapse that people are worried about creating. The bank run is the collapse. So you can see that they had to backstop this. Have you ever heard of the term moral hazard? This is just from Wikipedia. You can see in economics, a moral hazard is a situation where an economic actor has an incentive to increase its exposure to risk because it does not bear the full cost of that risk. For example, when a corporation is insured, it may take on higher risk knowing that its insurance will pay any associated costs. A moral hazard may occur where the actions of the risk-taking party change to the detriment of the cost-bearing party after a financial transaction is taking place. This is exactly what a moral hazard with banks is. The moral hazard from 2008 with the Troubled Asset Relief Program, the TARP program, removing the toxic assets of U.S. banks' balance sheets, the too big to fail. That created moral hazard because it told the banking executives, don't worry about making low risk loans that will be paid back with very low risk, because if you make these high risk loans and they don't pay you back and they become toxic on your balance sheet, we'll buy them. The American public will buy them because the American public has to have its banking system facade continue and continue and continue. That's a moral hazard. We have not learned any lessons since 2008. In fact, 2020 proved, and 2023, March of 2023 with SVB and Signature Bank proved that the moral hazard is even more a thing today because the FDIC and the Federal Reserve and the US Treasury Department cannot let any bank fail, not even one, because if one bank fails, the confidence gets sucked out of the system and bank runs are created, and a bank run will collapse our system. This is a very hard chart to read, but it is actually the percent of cumulative assets held by banks in treasuries, in bonds. How many banks did what Signature Valley Bank did, what SVB did, which was not make loans with their deposits, but actually go and buy US Treasury bonds with their deposits. Remember, we said that SVB had bought $100 billion of bonds. And that's what's happening is these banks are now buying bonds as opposed to, instead of their bread and butter, which is making third-party loans and then getting what we call a yield spread, a difference between what they're earning and what they're paying. That spread is where the bank's profit margin normally comes from. Instead of doing that, they're buying and they're investing in US Treasury bonds to basically ensure that deposits, to basically hold their deposits not liquid and cash, but have that investment and have those bonds to actually be able to meet those deposits. And so this has become a new thing really since 2008. You can see JP Morgan here has only got 15% in bonds, thank God. Bank of America 26%. But there's some banks down here that, have in excess, and really we're talking about, just the fourth bank on the list is already at 42%. That's Wells Fargo. PNC, 47%. Truist, 50%. What we're saying is these banks have not made loans to third parties. They've just bought US Treasuries as the way to invest their deposits. So as US Treasuries went down in value because the Federal Reserve raised rates, what happened? Stuff like SVB happened where they had to sell their bonds at a loss. And so what did the Federal Reserve do about that? They created the Bank Term Funding Program. I have a podcast just on the Bank Term Funding Program. The Bank Term Funding Program is a new facility, credit facility that the Federal Reserve opened where they said, we will buy your bonds back at 100% dollar for dollar, even though we've raised rates all this time to 5.25%. The Fed funds rate went from 0.25 to 5.25 between 2022 and 2023. Even though we've raised the Fed funds rate to 5.25 and your bonds are worth way less than they were when you bought them from us or from the Treasury, we will buy them back from you dollar for dollar. That is a program, BTFP, Bank Term Funding Program, that expires in March of this coming year, 2024. And JP Morgan analysts project that that could be $2 trillion. Now, this is really bad. If a bank has to go and exchange their bonds at par for cash from the Fed directly, this is a this is a sovereign, this is a, basically a red flag to the world that we are insolvent. So banks don't want to do this. This is the last resort for a bank. You have to understand that. But they will do it because they will have to do it if a bank run is coming. So let's talk about the FDIC and what does it insure and what is the FDIC. You can see here, this chart, which is a Y chart, you can see here from Q2 of 2003, which is our latest data that we have. From Q2 of 2003, we literally have $10.54 trillion of deposits at US banks that are FDIC insured. 10.54 trillion as of Q2 2003. What about the actual balance sheet of the Federal Reserve? This is the balance sheet as of December 31st, 2022, as populated and published on the public internet in February of 2023. You can see that their total assets is 128 billion. This is the FDIC Deposit Insurance Fund balance sheet as of December 31st, 2022. And you can see right here, total assets, 128.8 billion, 128.8 billion. Now, if you look, the cash is only 2.9 billion. Investment in US Treasury securities, 122 billion. So even the FDIC itself isn't holding cash. They also are holding US Treasuries. You can see a pattern. If everyone's holding US Treasuries and Treasuries collapse, we have nothing. The whole system is on vapors. So what other things have happened that, has been a change to obfuscate the reality of the situation? The thing I want you to know, because again, everyone is so focused on the micro, that they're missing the boat on what's really happening. And I want you to see this. This is the Bureau of Labor Statistics. This is from January of this year. And you can see the weight of increasing the relevance of the consumer price index weights. Every year on February 14th, there is a celebration of love. This February, BLS, Bureau of Labor Statistics, will celebrate an improvement in the consumer price index. You see how they write this so positively, so propagandizing us that this is a positive thing? We're celebrating this improvement, which we hope you will love. Propaganda, propaganda, propaganda. Beginning with the January 2023 index scheduled for publication in just 2 weeks, by the way. This is literally written, 34 days before it's going to get published. Beginning with the January 2023 index scheduled for publication February 14, BLS plans to update the spending weights in the calculation of the CPI every year instead of every 2 years. And boom, there you have it. This is how they switch things on us. Basically, instead of measuring the rate of basket of goods, of increasing goods and services over a 2-year period, because massive inflation followed, the trillions and trillions that were pushed into the economy through stimulus, coronavirus stimulus in 2020 and beyond, inflation followed because you expand the money supply and there's so much more money in the system chasing the same amount of fixed goods and services, finite goods and services. It makes prices go up. That's called inflation. Well, now that we have inflation, we can't really show them what 2022 looks like compared to 2020 because that's awful. We have to call inflation transitory in 2021, buy ourselves a year, then we'll come back in 2023 and we'll change how we actually look at the data from year to year as opposed to every 2 years so that people can't see an actual huge trend going up. No, what they'll see instead is they'll see us coming down, or we still have prices going up, but they're going up more slowly because we've tapered off stimulus a lot. So now they're going up more slowly. But certainly if you compare them to last year when they went up astronomically, it looks like we're actually making tremendous headwind because now it's coming down. So they present it as, look, the prices have fallen versus last year, as opposed to saying, but they're still up. They're just talking about the rate of increase is slowing down. So let's look at the interest rate hikes. We have never before in our history had such aggressive hikes so fast. You can see right here between 2023, 22 and 23, we raised 525%. There's never been a higher, faster hike period than that amount of time. You can see that we raised literally 2% here, but it took 3 years and it was only 2%. You can see that they raised slightly here from 04 to 06, 2%, but again, it was over a 3-year period. This is over literally a 1.5-year period, 525, and it just decimated the bond industry. We had the worst bond industry literally since 1788. So we're talking about centuries, the worst bond returns ever in 2022. Now, here are the actual hikes. You can see this is 525 beginning on March 17th of 2022. And our last hike was at the FOMC meeting of July 26, 2023. So that is an important date. We're going to come back to that. I want you to remember July 26, 2023 as our last rate hike. Okay. And so then what else is happening? You can see here, a lot of people are talking about and I am one of those people talking about the fact that the United States has absolutely fallen as a percentage share of total allocated global reserves. And, we're back down to a low point. Are we at the lowest point? No, we're not. Our lowest point was here. We were about at 48% in 1991. But right now, we're just under 60%. We were only under 60% ever before in 1980, and then from 1984 through 1996, we were under 60%. Since that time, we've been above 60%, but nope, now we're back dipping down because the world is saying something is wrong with the United States and how they're running their monetary policy, and I don't think I want to participate in it. This is going to show you that what happens with the Fed's monetary policy is, and what the Fed's assets are, is directly coordinated to the M2 money supply. So at the top chart here, you can say this is the Federal Reserve's total assets. And you can see that they were pretty flat all the way until 2008. This is where we had too big to fail, and the Fed's balance sheet jumped up and then sort of stabilized towards the uptrend. Then you can see 2013, we recapitalized some investment banks. We had some other investment banking issues that raised up the money supply again. We kind of stayed steady all the way until coronavirus stimulus, where we jumped up astronomically. Like, this is the largest jump ever in the history of the United States. And so we jumped up massively, and then we continued since 2020. It's not been just no big problem. We've continued for the Fed to raise their balance sheet with additional treasuries all the way until we started to come down with some quantitative tightening. This is not enough granular to see that this has actually gone back up, but you can see it on this chart. This is the M2 money supply. And look, it's been relatively stabilized until we get to that same period of 2008, in which case you can see, oh, nope, it started to really jump up at the beginning with the 2008 as well. You can see that here. You can start to see, wow, okay. And then after, so we gradually, this is why I say, beginning in 2008, we switched to modern monetary theory. You can see that the money supply astronomically, as a statistical change year over year, massively went up between 2008 and 2020. This upside projection is what I'm talking about with modern monetary theory, and it follows exactly what the Fed did. And then you look into 2020 and you see that coronavirus stimulus jumping up the money supply astronomically within a matter of months. That's why it's a straight line up. And then you can see it continuing to go up. In other words, we didn't learn anything. We continued to stimulate since 2020. We've been running these massive stimuluses. And you can see that we only had some slight diminution of the M2 money supply at the beginning of this year because Powell thought he was going to be Volcker-esque and be quantitative tightening. And he did tighten for several months until we had the banking crisis in March, in which case then a $300 billion deposit of increasing the balance sheet was once again made, and the money supply went back up again. In other words, how did they fix the banking problem? How did they fix the situation with SVB and Signature Bank? They printed more money. So if people are thinking, is the banking system solvent? And then the way the Fed fixes that is by printing more money. They're only exacerbating the problem, even though it's like being a drug addict. and you want to get off the drug, but every time you are in withdrawal, you have to get past that withdrawal by taking the drug. And you take the drug, so you can't get off of it. So you're never going to go through the withdrawal, but you're just compounding the problem until eventually you're overdosed and it's all over. It's exactly what is the United States. We are addicted to cheap, big money all the time. And if that stops, our banking system will collapse, and we'll fix it by printing more money until people really wake up and say, wow, what you're printing isn't worth anything because you're inflating my dollars. You're printing another dollar, makes the dollar that was already in my account that I earned and saved as my net worth, as my assets, as my value. It's becoming worth less compared to what it was because you're printing more money. This shows you, this is the Federal Reserve's balance sheet. This is recent present day 1 year, as you can see year to date. You can see that we were quantitative tightening. We were selling off our balance sheet. We were running off the balance sheet, 100 billion a month until we got to 2020. And you can see again, it's ticking back up. It's ticking back up. You can see here when the banking crisis happened, what did the Federal Reserve do? They just dumped $300 billion onto the balance sheet to save us. And Americans don't know any better and think everything's fine. So let's talk about the lag effect. The lag effect is how long from the last Federal Reserve rate hike, the last rate hike to the beginning of a recession. It goes back here to 1981. You can see that the last hike, 6 months later, there's recession. You can see 1990, the last hike, 15 months later is a recession. You can see .com, last hike, 8 months later, recession. You can see too big to fail, last hike, 17 months later, recession. 2019, last hike, 10 months later, recession. And now we had our last raise on July 26th of 2023. The average of these months is 11. That would put us in recession in June of next year if we were following normal cycles, but we're not. You ask why those CEOs said 84% of them said there is something coming in this 2024 period. And that is because these CEOs know that there is $2 trillion of debt that is going to get refinanced. This is Bloomberg Goldman Sachs Global Investment Research. And you can see that we have in 2024, we have another, this is as of September. So we have less than 230 billion now to mature because we're in the last week of the year here. But you can see that in 2024, we have just under $1 trillion that has to be refinanced. And in 2025, we have over $1 trillion that has to be refinanced. So we got $2 trillion between now and the end of 2025 that must be refinanced. And it's going to be refinanced at a 3x or 4x cost of capital than these CEOs have had to deal with for 15 years. So the CEOs are saying, I've had 15-year run of super low cost of capital, and now I have to refinance $2 trillion in the next 2 years at a 3 or 4x price point. And this is why the Federal Reserve is cutting rates next year. We have had a yield curve inversion. Yield curve inversion is U.S. Treasury yield curve has been inverted for more than a year, meaning short-term bonds are paying higher interest rates than long-term bonds. This unusual occurrence, known as yield curve inversion, has historically been a reliable indicator of an upcoming economic recession. Since World War II, every yield curve inversion has been followed by a recession in the following 6 to 18 months, and recessions are naturally correlated with decreased stock market returns. History has shown that any economic fall following a yield curve inversion doesn't happen immediately. Signs that the Federal Reserve will maintain higher interest rates for longer will likely result in a persistent yield curve inversion for now. So what this is telling us is that I just wanted to point this out. Since World War II, every single yield curve inversion has been followed by a recession within the 6 to 18 months following, and that results in decreased stock market returns. So we are not going to escape the recession. We are not in a Goldilocks. We are not in a soft landing. We are not going to just magically escape and think everything's going to be fine. Yet, what have they successfully done? They have successfully convinced the world that that is what's happening. And the world is leaving their safe cash position, which in a bank we've discovered and put out the facts that it's not safe. It's just based on the confidence of the American public. So if you're in cash and you perceive that to be safe, you think, well, I don't want to fear of missing out, FOMO. I don't want to miss out on the 2023 returns. I sat on the sidelines. 2023 was too nervous. I'm going to go back in and get some returns. And all of this money is going to flow back into the equity markets in the perfect time for them to then collapse our markets and move us to their new system that they have planned, designed, and engineered to come all along. This is a Barron's article from October that just talks about that one of Wall Street's favorite recession predictors, an inverted yield curve, is getting less inverted, but it's not all good news for investors. How the curve uninverts also matters too. So if we too aggressively cut rates, like the market is pricing in 6 cuts when the Fed has only said there's going to be 3, then we have other repercussions for that. Again, folks, we have never been here before in the history of time. We made a massive change in 2008 to just print, and believe there's no repercussions. We took that to the nth degree in 2020 with coronavirus stimulus. And now we're in a uncharted territory of nobody knows where this ship is going. And if there is consensus that it's going in one direction, you should run in the other direction, because that is obfuscation to get the masses of American people to put their money somewhere, and then they collapse the system and you lose your net worth. So what's coming? What's next? This is a paper printed in July of this year, July 2023. It is a paper about the status of global central bank digital currencies. You can see here, making headway, the results of the 2022 BIS survey on central bank digital currency and crypto. A lot of people make the confused assumption that central bank digital currency is cryptocurrency. That is incorrect. While they both leverage the blockchain, central bank digital currency is exactly that. It is centrally controlled by the central bank. In the United States, that would be the Federal Reserve. The Bank of International Settlements is the central bank of central banks of the world. And the Bank of International Settlements is basically promulgating, we have to end currency as we know it. We have to go to digital currency because the system is at the end. We are at the global precipice of the stimulus system breaking down. Everything I've just walked you through in the last hour shows you that we are at the end of the stimulus system, that no longer can we have a crisis without printing massive amounts of money, inflating the money supply, raising rates, cutting rates to try to fix back to a stimulus environment again. We are at the end of it. We are at the end of it. The Federal Reserve still has over $7 trillion of assets on their balance sheet, treasuries and bonds on their balance sheet. If we had another crisis, what are they going to balloon their balance sheet to? 20 trillion? Our US debt is 33 trillion, 34 trillion. So the answer for the central banks is to end currency as we know it and to move us to a central bank digital currency on the blockchain that they 100% control. That is their resolution. Ending the current system of paper cash, money anonymity, where you can spend it where you want, how you want, when you want, and everything becoming digitized, which requires digital ID. And then not only digital ID, but they will be able to control what you do and how you do it with your money. Let's look at some of the key findings from the Atlantic Council in studying CBDCs. There's an atlanticcouncil.org CBDC tracker. This is the source of this information. You can see here, key findings, 130 countries representing 98% of global GDP are exploring a central bank digital currency. In May of 2020, only 35 countries were considering a central bank digital currency. A new high of 64 countries are on an advanced phase of exploration, development, pilot, and launch. 19 of the G20 countries are now in the advanced stage of CBDC development. Of those, 9 countries are already in pilot. Nearly every G20 country has made significant progress and invested new resources in these projects over the last 6 months. 11 countries have fully launched a digital currency. China's pilot, which currently reaches 260 million people. That's a really, for America, that would be a lot because we only have 340 million people. But China with 1.4 billion, this is a very small test sample for them, although it's almost the size of America. That 260 million people are being tested in over 200 scenarios, some of which include public transit, stimulus payments, and e-commerce. The European Central Bank is on track to begin its pilot for its digital euro. Over 20 other countries will take steps towards piloting their CBDCs this year, 2023. Australia, Thailand, Russia intend to continue pilot testing. India and Brazil plan to launch in 2024. In the United States, progress on retail CBDC has been stalled. However, other G7 banks, including Bank of England, Bank of Japan, are developing CBDC prototypes and consulting the public and private sectors on privacy and financial stability. In the United States, we have what we call the FedNow platform, the blockchain platform, and the digital dollar is the CBDC. The FedNow platform launched in July of this year. So while this report says that the United States progress is stalled, it's actually quite moving in 2023. The US is moving forward with a wholesale bank-to-bank CBDC. Since Russia's invasion of Ukraine, the G7 sanction response, wholesale CBDC development has doubled. There are currently 12 cross-border wholesale CBDC projects. This is DeSantis in March of this year, basically slamming central bank digital currency, saying that we are not going to use the big brother digital dollar. So their solution is that we are at the end of physical currency production and stimulus that we've been leveraging since the beginning of the 1917, 1921 era of the US dollar being hegemonically global status reserve. Because we can see a bank failure and what the Federal Reserve had to do, which was to guarantee every bond that bank bought dollar for dollar to redeem that bond for cash, dollar for dollar, even with it being substantially diminished in value because of the higher interest rates. Remember that your bond value is inverted to your interest rate. So as interest rates go up, bond values go down. As interest rates go down, bond values go up. So the answer is them moving us to a new system. The system is central bank digital currency, centrally controlled. It is to start country by country until it gets consolidated into one world global digital currency. And of course, along with that, they want one world government. And I don't have time for that in this podcast. I'm just trying to give you the economic fundamentals of why we are at this precipice and we are at the end. So I'm going to take the last 5 minutes here or so, maybe 10, I'm long-winded, and I want to just give you the economic data that we are at this last week of December of 2023 to show you that if you're not following a bridge asset strategy, if you're not invested in assets that will withstand, that have true hard intrinsic value, real estate, commodities, precious metals, then you will be finding that your financial derivative assets, with the exception of potentially cryptocurrency, not central bank digital currency, but cryptocurrencies that are decentralized on the blockchain, like Bitcoin, Ethereum, XRP. With the exception of cryptocurrencies that are decentralized on the blockchain, if you are invested in financial derivatives, you have a high risk of, when the reality of our economic situation is no longer able to be obfuscated, when it can no longer be hidden from you, that you will be in financial derivatives, and those financial derivatives will lose a substantial amount of money. And then the transition to digital currency coming would mean that not only do they control your wealth through their control of central banks and digital currency payment processing facilities, but they also, you've lost a lot of it. So let's look at the present day situation. You can see present day. This is the total return. And you can see these are the market caps. The S&P 500's average 12.7 billion market cap. Russell 2000, 300 million to 2 billion. Microcaps 50 million to 300 million. You can see this is a Y chart through September. You can see the S&P was at 18. We're at right now just under 23% for the year. Russell 2000 was at 710 in September, and microcaps are actually negative 2%. So you can see that basically the S&P really is performing, and all others aren't really performing. And why is this? And it's simply a matter of the Magnificent Seven. And you can see the Mag 7 here: Meta, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. You remember the FANG stocks? Pretty much a lot of these FANG stocks are still here. Facebook is Meta. Apple is still here. Netflix is not on this list. That would be a FANG stock. Nvidia is on this list, and Google is on this list. But you can see these 7 stocks represent 28% of the S&P total market cap, and their average return of 100% amongst the 7 of them has pulled up the total 2023 results immensely. And this is what it is. Meta, 152%. Nvidia, at 206% return. Tesla, over 100% returns in 2023. And this allows the S&P to overall show that they're at a 23% return for the year in 2023. But if you take these out, you've got a 2% return, if that. So the 493 companies that make up the rest of the S&P are absolutely not on the winning side. You can see this report from November 30, tough times, new 2023 rent delinquency reaches a record. 41% of small businesses can't pay their rent in November. This is a real estate expert. We are in the first inning of a commercial real estate correction, billionaire real estate investor Jeff Green says. Why are consumers still spending? Why, when credit cards are getting to over $1 trillion, the highest level of credit card debt we've ever had in the history of our country, how are they still spending? And it's because you can see in this Wall Street Journal article from December 17, right here, buy now, pay later keeps people spending without the credit agencies even knowing, because it's not a credit approved purchase. You're going to these 3 big Afterpay, Affirm, Klarna, that basically at your checkout, when you can say, oh, I want to pay Apple Pay, I want to Venmo, I want to pay with my bank account, I want to pay with a credit card. Oh, and then I've got, Klarna here, and I can pick that and pay this over 3 months. And Klarna is underwriting it and not even maybe doing a soft pull on my credit, not even reporting that to the credit bureau. So we can see consumers are still buying, but they're buying on installment plans that are not even getting aggregated data outside of these 3 companies. And then you see, this was an article from Zero Hedge from December 18, 40% of student loan borrowers missed their first payment after the pandemic era freeze expired. That's $5 billion expected to come back in. 40% of that wasn't even paid. People can't afford it. They got used to not paying these debts for 3 years, and now they can't afford this $300 to $500 to $700 to $1,000 to over $1,000 payment on a monthly basis with their budget, especially because everything's gone up. Then what do we see in Europe? German business expectations fall, dampening hope of a rebound. IFO business expectation index falls to 84.3 when economists had estimated to be 85.6. The economy remains weak as the year draws to a close. The economy is weak. It's IFO President Clemens Furness said, we have been waiting for a recovery now for some time, and it is not coming. Hedge funds turn bearish on the dollar. Goldman sees more losses. Net dollar positioning bearish for the first time since September. Goldman shifts as Fed moves towards non-recessionary rate cuts. December 17, 2023. Goldman Sachs Group added its voice to a chorus of expectations of a weaker dollar after the U.S. central bank's clearest sign yet that interest rate cuts are coming. The bank made sweeping changes to its exchange rate forecast after the Federal Reserve signaled a more rapid move to non-recessionary interest rate cuts. Goldman analysts included Michael Cahill wrote in a note on Friday, after the meeting, hedge funds and other large speculators switched to a net short position against the dollar for the first time since September, according to Commodity Futures Index Data Commissions as of December 12th. We have the situation in Israel between Israel and Hamas, which is basically led into the Red Sea. And now you've got this Danish company, Maersk, the second largest container ship operator in the world, pausing all ship traffic because one of their ships was attacked in the Red Sea. This has just happened December of this year. The world's second largest owner of container ships said in a statement Friday that it has instructed its vessels headed for the southern entrance of the Red Sea to pause their voyages. Its vessel, Maersk Gibraltar, was attacked shortly after Maersk's announcement. Germany's Hapag-Lloyd announced a halt until Monday. Then they will decide. You have global shipping interruptions and disruptions, and you had Defense Secretary Austin Lloyd come out and say that we're gonna make sure that this Red Sea trade keeps happening and the routes are open, and yet Maersk is still saying, we're not doing it. And then what is the rest of the world doing? This is the most clearest case of a differentiation between the United States Federal Reserve and the rest of the world, because you've got ECB and BOE, which is the European Central Bank, and the Bank of England, which runs the UK, which is now no longer part of the European Union. They are reluctant to join the Fed and pivoting towards rate cuts. This is on Bloomberg, and you can see here, December 14th, Powell's signal does not get echoed by Christine Lagarde or Bailey of the BOE. European central bankers are shifting the stances only slowly, very data dependent. The ECB should absolutely not lower its guard, Lagarde says. Lagarde was quoted as saying that you cannot go from a solid to gas. You must pass through the liquid phase first. She's saying data and rate cuts are not even open for discussion at this time. Europe and UK will get a CPI print in April of next year. They're not going to probably lower anything until April. So that puts a lot of pressure on Powell, since the market is already pricing in a March of this coming year 24 rate cut. Final thing I want to just give you is just a continued knowledge that I'm expecting an internet disruption, some kind of disruption. I can see, and the sources of information are coming, that we're going to see some kind of action in the oceans, some kind of new weaponry in the oceans that are going to be implemented pretty early on here, especially with all the geopolitical risks in the Middle East and still continuing with Russia and Ukraine. So I'm expecting some kind of, internet disruption, blackout. We know, if you look at the Julia Roberts, Ethan Hawke movie on Netflix, one of the #1 movie I think in the country right now, it's called Leave the World Behind. I highly suggest you watch that movie. It is a precursor of the capabilities that they have published in open format for the American public to digest and consume, and to understand exactly how a government overthrow, a financial system overflow, moving us from paper currency to digital currency overnight, could and likely will try to be to happen in 2024. What are the things that have already happened? You've got the Bank of International Settlements basically doing cross-border retail CBDC payments through Project Icebreaker. So those things that we said that are coming. And we are really in a time of de-dollarization. We are in de-dollarization. Our Forex reserves denominated in US dollars is sub 60%. And with the exception of those periods I showed you, that's where we are. The Enbridge, which is the cross-border CBDC usage for the BRICS nations, Brazil, Russia, India, China, South Africa, soon to be joined next month in 1 week by Saudi Arabia, United Arab Emirates, and Iran, because those 3 blocks are getting added on January 2024. We are looking at that block having more GDP in it than the G7 countries of the rest of the world. Our G7 doesn't have the same GDP as all of the countries that are moving to the BRICS block. And they are already quite far along with some of their retail CBDC digital yuan. I just want to show you this too. This is actually an old article, but I just wanted to show you from last year that you saw in 2022, there was a record number of countries that shut down their internet. Access to internet services restricted 187 times by 35 countries, including Iran, India, Myanmar, which is Burma, repeatedly enforcing blackouts. So countries have the ability to shut off communication to their citizens and their constituents, and you should prepare for that. You should prepare for that, because as we go through this massive economic transition, information will come it will be at a premium, and we will unfortunately have the ability to shut down. And the last really big, and this is the Epoch Times, the last really big thing I want to bring up is this Twitter files. We have 2 now U.S. Supreme Court cases that will be heard by the U.S. Supreme Court regarding the 2020 presidential election. It's come to a head now because basically Trump looks like he will be on the ballot. You just had the Supreme Court of Colorado state that he cannot be on the ballot. That is immediately being appealed to the Supreme Court. And the Supreme Court, will have to take that up. That has to be, they have to grant cert on that. And then you also have Jack Smith, who bypassed the DC Circuit Court of Appeals and petitioned the Supreme Court directly to hear the case because he wants to get Donald Trump basically tried for his 2020 election fallout, what he did when he was basically saying, I won this election, it was stolen from me. He wants to say that that was an insurrectionist move, and therefore he is prevented from running again. And he wants to have that trial the day before Super Tuesday in March. So had the DC Circuit taken up the matter, it would never have been heard in time. So he has, for political reasons, expedited the U.S. Supreme Court. USSC has something called the political question doctrine that basically states that if there's something that is a political question, we will not decide. We will always let the American voter decide at the ballot box. So this is going to be 2 cases that are related to the Twitter files. Other cases that are in federal court right now related to Twitter files are the pure literal government state action. This is all legal speak that I'm talking as a lawyer, but there's state action of local, state, and federal government agencies with a database, a communication system directly into Twitter, telling Twitter what posts they want shadow banned or all out removed, or what people they want removed off of Twitter in the 2020 election cycle. And so that is another case that we're seeing that our federal government is a lot more manipulative and information controlling than we ever realized before. All of these cases are now legal process takes a lot of time, you guys. And so even though the election of 2020 was 4 years ago almost, and it seems like it's who gives a care anymore, the truth is that these cases have percolated to a certain point, and they are going to be something that does get rectified in 2024 as well. So I will just say to you in conclusion that, one other thing I wanted to point out is go watch my podcast from this year. The podcast is called Unraveling the Web of Globalization and the Totalitarian Control of Humanity. This is one of the most important podcasts I've ever done. It is all about what happened with the pandemic and how they leveraged and changed the laws prior to 2020 to be able to implement exactly what they implemented in 2020 through the coronavirus pandemic. If you have not watched this, you are doing yourself a disservice. I highly recommend you go and you watch this podcast. And with that said, I just want to say, always feel free to reach out to my team, info@Walser Wealth, or call us 866-92-WEALTH, 866-92-WEALTH. 2024 is the year of the largest changes in the history of economic time. This is it. We are here. And I will strongly encourage you to make sure that you're as self-sufficient in any kind of collapse. Watch that Leave the World Behind movie and see what you could do to improve your situation in the event that something like that happens. If you're prepared and nothing happens, great, no skin off your back. If something happens and you're not prepared, it could really be, it's just not something that we do. We prepare. So, and financially prepare by leveraging strategies that will endure through hard assets, through assets with intrinsic value, to the new system that is coming. And that would be GFS. All right. Until next year, everybody. Merry Christmas. Hope you had a great one. Happy holidays and happy New Year. Take care, everybody.